Okay, okay, thank you. Thank you so much, Joanna. Good morning, good afternoon, good evening to all of you, wherever you are. Welcome to this session, IFF Academic Dialogue. Today, we will spend the next hour and a half to discuss China's economic prospects, challenges, and policy priorities. I feel this is a good time for this discussion, particularly in light of the recently concluded 2 sessions, as well as economic developments in the first 2 months of this year so far. As we all know, in the government work report, Premier Li Qiang laid out China's key economic targets for 2024. These include real GDP growth rate of around 5%, government fiscal deficit of 3% of GDP, CPI increase of around 3%, and unemployment of around 5.5%. Among all these targets, the one on the real GDP growth rate has drawn a particular attention and extensive discussions among market observers, both in China and abroad. The key questions are, is this target reasonable or overly ambitious? What could be the key drivers of growth this year and beyond? Given many challenges facing the economy, what policy measures may still be needed to achieve this target? China's economic developments in the first 2 months are encouraging. Industrial production expanded by 7% year-on-year in January and February, the fastest rate of increase in almost 2 years. Retail sales were also up. Exports also jumped in the first 2 months by 7.1% in US dollar terms. However, I understand that the property sector investment fell by 9%. All in all, key economic data marked an improvement thus far in the new year, with economic momentum likely to continue to improve in the months ahead, but structural challenges remain. Given the size of the Chinese economy, what happens in China will also affect the global economy. China has contributed about 1/3 to the global growth in the past 2 decades. Looking ahead, whether China will be able to maintain this pace of contribution is also a question of great interest to the audience. So that is the background. I welcome all of you attending this dialogue. I'm sure many of you are from China, but some of you also from elsewhere in other parts of the world. Welcome, as I said, whether evening or morning or afternoon, equally welcome. So we're very lucky today to have 3 really distinguished speakers to help us understand all these issues. So let me quickly introduce these 3 speakers. Steve Barnett. Steve is currently IMF Senior Resident Representative in China. Steve joined the IMF in 1997. Prior to his current assignment, he held many senior positions on economic policies and country work in the IMF. Steve has published widely on world and Chinese economic and financial issues. Wang Tao. Tao is currently Managing Director, Chief China Economist, Head of Asia Economics at UBS Investment Bank. Prior to this, she worked in IMF as a senior economist. Interestingly, Tao and Steve were in the same young economist program in the IMF in 1997. They are still so young today. Tao has recently written a book about the Chinese economy entitled Making Sense of China's Economy, which has been rated as one of the best books on the subject. I've had the privilege of working closely with both Tao and Steve when we were together in the IMF. Wang Dan. Dan currently is the chief economist of Seng Bank, responsible for China-related research and macro analysis. Prior to this, she worked in the Economist Intelligence Unit in the Chinese Academy of Sciences. Wang Dan is regularly quoted in Chinese and international media. Though this is the first time, Dan, that we're working together, I've read and watched many of your informative and very insightful research articles and video interviews. So a quick word on the format of today's discussion, which is quite simple, straightforward. I will first ask our speakers on their takeaways from the two sessions, and will then ask them a few follow-up questions on both the short and the long-term aspects of the Chinese economy. I will then open the floor for questions from the online audience. For those who would like to raise questions, please indicate or write in the chat box. I already have received a question so far. So let me now proceed with our discussion. My first question is a pretty broad one, is about takeaways from the recently concluded two sessions, as well as the recent developments so far in the first 2 months. Steve, if you don't mind, my first question to you, then followed by Wang Tao and Wang Dan. To Steve, early last month, the IMF released its annual economic assessment report called Article 4 Consultation Staff Report on China's economy. Can you tell the audience the main conclusions and the messages of that report? How would you see the report policy recommendations in light of your takeaways from the two sessions and the recent economic developments? If you don't mind, could you kindly try to limit your answer to 5 minutes, if possible? Still, please.
Great. Well, thank you very much for inviting me. Really a big thanks to IFF, and it's great to be with old friends, Tao and Dan, for this event. If I can take the privilege of going first, maybe I can even take a step back from the IMF report on China and look at the IMF view on the global economy, because I think that's really important to frame this discussion. So really quickly, the IMF characterized the global outlook in late January as resilient but slow. Why do we say slow? Because basically we have global growth this year at 3.1, next year at 3.1. This is our forecast from January. But if we compare to the 2 decades before the pandemic, we know that global growth was averaging 3.8%. That's one reason it's slow. Moreover, we knew that the pandemic had a big shock on growth. So rather than catching up to pre-pandemic trends, the global economy is seeing a lot of scarring. And our medium-term growth forecast is the lowest we've had in decades, also at 3.0%. So this sort of frames a discussion when it comes to China. As you mentioned in your opening remarks, China's really had a remarkable development track record. Over the last 25 years, average growth has been over 8%. Huge gains in living standards. As you noted, even last year, China contributed 1/3 of global growth. And that kind of comes to your main question to me. What's the key message from our recent Article 4 report? I think the key message is how to secure strong and sustainable growth in China in the near term and in the long term. And the policy message there is that this is not just important for China, it's actually important for the global economy. So let me turn first to some of the short-run considerations. And I think when we look at growth last year in China at 5.2% and over the last couple of years, we really need to factor in what's going on in real estate. And the efforts to right-size the real estate market are welcome and necessary. But when we think about real estate, it's about 1/5 of value added if you count upstream and downstream industries. About 90% of urban households own a home. It's maybe the largest form of wealth. Really important for local governments. We also know that housing had affordability concerns. So here the government effort to right-size the market. The challenge now is to do so in a way that minimizes the economic costs, but it was going to have costs because the simple size of the market and the amount of adjustment that was needed. So we've seen good progress in getting the market towards the right size. The key policy advice for the fund would be to continue to secure maybe a faster recovery in real estate with efforts to accelerate the restructuring of viable developers and the exit of unviable developers, fix the pre-sales model, and so on. I can go on. And other area in the near term would be macro management. We see room for fiscal policy to be broadly neutral, as we define it, but to rotate away from investment more towards consumption as a means to help secure the recovery in the near term. And the last set of issues is the long run. And maybe we can come back to some of these, so I'll be quick, but really three medium-term or long-run issues that the report focused on. And I think first and foremost is how to boost total factor productivity. I know that's very econ speak, but long-run growth ultimately is going to depend on the pace of economic reforms, the ability to use capital and labor better. I think the second area we focus on is consumption, finding ways to make consumption or really have consumption continue to be a key driver of growth. Last year, consumption explained about 80% of growth. How can we continue that going forward so that consumption is the main source of demand and grows faster than GDP? And last, but definitely not least by any means, is how to secure green growth in China. And China's made good progress towards achieving its climate goals. And I think this really summarizes the whole theme of my remarks, that China achieving its climate goals is clearly a win for China. It's a win for the global economy, and it's a win for the planet. And I'll stop there. Thank you.
Thank you very much, Steve. I know that the Article 4 report is very, very rich in data, information analysis, and policy recommendations. It was a bit unfair for me to ask you to basically give a summary within 4 or 5 minutes, but you did very well. Key messages are that the world economy is slow but resilient. China's growth is very important for not only China itself, but for the world. Short-term issues, property sector, then fiscal policy probably has a room to do different things within the neutral stance. Then the question is longer term, how to boost total factor productivity, then consumption, as well as green growth. So you covered all the key issues for this discussion. Thank you. Wang Tao, to you. Could you please share your view of your takeaways from the 2 sessions? If possible, a little bit from the market perspective, since you are in the market every day. Thank you, Tao.
Thank you, Jianhai, and hello, everyone. So before I go into the 2 sessions, let me just very briefly comment on the data that we have gotten for the last couple of months. As Jianhai mentioned, that most of the economic data for January, February surprised on the upside and showed better than expected performances in many areas, especially export, and that reflected the upswing in the global tech product cycle, but also resilience in the global economy, especially US demand, because China's exports to US rebounded, and especially consumer goods outside of the tech products. Also, during the Chinese New Year holiday, there was a strong release of pent-up demand of consumption, especially services, restaurant, catering, domestic tourism, and so on. That is reflected to some extent in the retail sales number, which also improved somewhat in terms of the underlying momentum, even though it's a bit slower than December, but December had a low base. And also, both the infrastructure investment and manufacturing investment remained quite robust. So these are some of the positive. But on the other hand, we monitor, as you mentioned, we're on the market, so we monitor many of the high frequency data, daily property sales, daily truck traffic, and also work resumption post-Chinese New Year at construction site. So what has been happening is that construction site resumption has been slower than usual post-Chinese New Year. And we have also noticed that property sales continue to decline very sharply, around 45 to 50% on a year-on-year basis. And the truck traffic and everything also are slowing. The only exception is port activity, so exports is still quite resilient. So that's the general picture. I would say better than expected performance in January, February, but I think the momentum may be too early to say there can be sustained. So there is still downside risk, especially related to property and related to consumer confidence. So then coming to the two sessions. So I wanted to make three main takeaways from two sessions. The two sessions reports are also very rich and covers everything. So I just wanted to highlight maybe three things. One is, I think the growth target of around 5% this year is relatively ambitious. Last year, the 5% target is prudent, conservative, because last year we had a low base from post-COVID from 22, so it's easier to achieve that 5% in 23. This year, that base effect is not there anymore. We are still feeling the pressure, downward pressure on the property market. So I think it's a little bit ambitious. And the policies that has been announced so far seems to be relatively modest. And we look at the fiscal expansion, not just at the budget deficit, but also the off-balance sheet items, and put it all together following the IMF convention, looking at augmented fiscal deficit. We estimate the expansion will be 1 to 1.2% of GDP this year. Last year was almost zero. So definitely there's more policy support. That's good, but it's not a big stimulus. And also the government announced action plan to support in equipment upgrade and consumer goods. But the action plan did not specify any specific subsidies for consumers. So any likely help from the government may be limited on that front. And so that's the modest expansion. So therefore, I think to achieve this year's 5% target may still be a bit challenging at this rate. And we expect more policy support coming through later on. The second point I wanted to make is on property. I think especially on the property side, and Steve mentioned a lot about the structural transition away from property and the government's attempt to de-risk from the sector. So we are going through that adjustment, painful adjustment. So it's understandable that the authorities remain reluctant to give more support to the sector at the moment. And given that activity, sales and starts, so sales are down 20% year on year, starts are down 30% in the first 2 months. And high frequency data and 100 developers contract sales decline more than that. So there are some inconsistencies a bit in that, but nevertheless, I think the downward pressure on property and its negative impact on the rest of the economy is still very acute. So the authorities may need to put through more support, including widening the whitelist for developers, HUCO reform, and so on, to help stabilize the property market sooner than or at to prevent it from going down too much more. So that's, I think, another point takeaway. The third takeaway from the two sessions, I think that it's well noted that the work report from Premier Li tried to balance short-term growth with structural reform and structural change. So the report mentioned a lot of structural policy areas, including increased spending on social areas, and urbanization, spending in rural areas, the green transition, innovation, and so on. So those measures, of course, will take time, but we can see that authorities definitely are looking beyond just the short-term, policy, short-term cycle at the moment, and trying to put in policies for to foster that medium-term transition. So here, just wanted to echo what Stephen mentioned, and IMF has recommended that I think in this transition, supporting consumers through better public goods and public services and social safety net, including hukou reform, pension reform, increased public spending in healthcare, would help both in the short-term and long-term transition. So hopefully we'll see more policy on that front. I'll stop here. Thank you.
Thank you very much, Tao. Very succinct and timely analysis on the economic performance so far this year. You mentioned several things, export performance, for example, which we will refer to later on in our discussion. You also commented on the growth target. Again, we also will have opportunity to further expand our discussion. I noticed one thing, particularly interesting. You mentioned relatively several times, relatively ambitious growth target, policies relatively modest, and fiscal policy relatively expansionary, 1 to 1.2% GDP. So very well put, and also short, longer term property sector and other issues. So we will have a chance to come back a little bit later on. Thank you so much for your thoughts on the performance. Wang, what are your reflections on the two sessions? What impressed you most from your point of view?
So I'll start with the first 2 months of economic data as well. The two things that really stood out was industrial production and infrastructure spending. They both exceeded expectations by a great deal. And that's sort of in line with the message coming out with the two sessions. One message is mainly on the supply side. Of course, that has been a message for the past decade. Ever since 2015, the supply side reform has been the key to manage China's economic growth. And then when it comes to how to stimulate the short-term economic growth, there was very, very little mentioning. Of course, we have seen the tone have been relatively positive about a monetary policy. It's still robust, but it sounds like there's an intention that it might relax it when the situation changes. Because we know the first quarter data probably will be quite difficult to have a satisfactory result, since last year we had a relatively high base due to reopening of the economy. But if the economy was not performing well in the first quarter, there's likely to be a monetary expansion, but more likely in terms of cutting the RRR rather than a direct cut of the interest rate. And when it comes to the fiscal policy, it looks like that's going to be the main driver for the economy this year. One key takeaway from this two session is that the central government, of course, will take more of the debt burden from the local government so that they could have more funds in their hand to spend on some of the major projects. But simultaneously, we have seen some contractionary measures starting from earlier last year, including some of the constraints for 12 provinces when they try to implement new infrastructure spending. If a local government is too deeply in debt, actually there's very little incentive for any level of government to borrow more in the open market or to start any project just out of the growth concern. So the tone from the two sessions, of course, is positive. But similar to last year's situation, people had high hope after two sessions, but then there was a wide disappointment as time went by. What happened throughout the year was actually monetary contraction, fiscal contraction, and housing market contraction. And the focus was primarily on the supply side, the productivity, and the long-term growth. So the government's role seemed to be more of a managing risk rather than stimulating the short-term demand. That's why I think the economic situation this year won't deviate too much from last year. But reaching the 5%, of course, will be much, much more difficult, given that we do have a higher base last year. And when it comes to consumption, although there were talks about replacing the old consumer goods with new ones, maybe towards some of the green products, but this essentially is still subsidizing producers, some companies, rather than subsidizing consumers. A direct cash transfer would still be the most effective way. But based on the observation in the past 2 years, there was very little appetite from the government to do this. And as a result, the only option left for the macro policy was infrastructure spending and then net export, basically. So if for some reason that China can secure a bigger overseas market, maybe getting a better relationship or out of the kindness from European economies, then we can have a higher export value. Or we do well in Southeast Asia, then the net export would be a major contributor to the GDP growth as well.
Thank you very, very much, Wang Dan. Very well, summarizing your understanding of the two sessions, mainly on the supply side, long-term issues, and relatively little on the short-term policies. For you, that fiscal policy will be very important, and infrastructure spending, net exports will be the key drivers for growth this year, while consumption may be difficult to be boosted without more direct measures. Very, very well laid out the basis for the discussion to follow. So then my second question is about the economic growth target of around 5% set for 2024. And the three of you already mentioned. My question here are several. You can pick one or two to focus on. How do you see this target? Actually, Wang Tao and also Wang Dan mentioned already, reasonable, ambitious, or unrealistic. So three terms you can use. What are the driving forces behind this target? I think you already have mentioned, but if you want to elaborate a little bit more, that'd be very helpful to the audience. And what could be the headwinds for achieving it? Again, you already mentioned what macro financial policies may still be required. I think you all mentioned these points briefly, but I think given the importance of this growth target for this year, and particularly for the audience we have today, if you would like to spend a little bit more, elaborate your points of view, that'd be very nice. Try kindly to limit to 3 minutes. So this time, if you don't mind, I'll first ask Wang Tao to give an answer, and then to Wang Dan, and then Steve. Thank you, Wang Tao.
Thank you. Yeah, to elaborate, so I use the word ambitious. So I think it's not unachievable, but the policies that we have so far may make it difficult. So what are some of the driving forces behind it? So in my baseline assumption for this year's growth, I have a big assumption that property market stabilizes and not fall very significantly. When I mean stabilize, I mean sales fall maybe 5% in volume and starts for 10% and prices for 10% and not more. If that's the case, then I think consumer confidence may stay weak, but they do not fall off a cliff. And then consumption can resume its post-COVID normalization and recovery, along with a modest growth in the labor market and household income. So basically, consumption will be a key driver. Not that it will grow higher, it will definitely grow slower than last year, but it will contribute the most to growth. And that is going to be driven by improvement in the labor market and some release of excess saving from the COVID period, which has not been released last year. And then I agree that net exports will be a positive contributor to growth this year. I mean, last year it was negative, not because of the goodwill of the Europeans, but because of the upswing of the global tech cycle. And China is a big part of the tech supply chain, and that benefits the export when the cycle is in upswing, that benefits Korea, Taiwan province, China, Vietnam, and so on and so forth. And we already see that happening. And also we think that the US economy seems to have remained resilient and probably will again do better than most of us, including my colleagues, had expected early on. And so again, I think that global import demand will probably be better than last year, because last year developed markets had destocking, had a lot of those adjustments. We think those adjustment is over. Even though those economic growth may be weaker, but their import demand for goods may be stronger, and then China will benefit. So I think that exports is a contributor. We think that infrastructure investment, however, it will stay robust, but we don't see it accelerating, because even though the central government is issuing special bonds and so on, special treasuries, the Wang then mentioned the contraction at the local financing level that is continuing. And so overall, the fiscal expansion is limited, and especially for infrastructure investment. So we see it robust, but not really accelerating from last year, so not adding too much. And the biggest then headwind, to all this is going to be property market. If property market does not stabilize in the next few months, consumer household wealth could be affected. In China, 60% of household assets are in real estate compared to 30% in the US. So housing matters a great deal, and mainly through confidence, I believe. And if the property prices start to fall much more sharply, that could weaken the confidence and prevent release of excess saving. Of course, the economy is weaker. So that's the biggest headwind. And so therefore, in terms of policy, I think I agree that direct subsidy to household would be helpful. It's not coming. I also agree that I mentioned the boosting, social safety net and hukou reform will help as well for consumption. That will be longer to release. But in the short term, I think any policy to stabilize the property market will also support consumption and therefore support growth and to achieve that 5% target. Thank you.
Thank you very much, Wang Tao. The message is very clear for the short-term prospect and your policy recommendation on the property sector. Thank you. Wang Tao, please.
So I absolutely agree with Wang Tao's assessment on how big a hole that housing is digging for this economy. And I also agree that consumption will be put up if housing market is stabilized. I just don't think it will happen this year. Our projection for the housing market this year is that both investment and sales would contract further to a bigger extent than last year. And the main reason is that when we look at several main indicators, the completed area of residential housing, for example, is way higher. The growth of completed area of residential housing is way higher than the sales growth and is way higher than the new investment in residential housing. So this has been the case throughout the past 2 years. And by the end of last year, there was overflooding of the completed projects. That was from 2 years ago. So since Baojialou, the securing of the delivery of ongoing projects has been a priority in the housing market, then all the real estate developers are trying to just finish their projects, get it back to the prepaid household. And that has resulted in a short-term supply-demand imbalance. The supply way exceeded demand. And when durable goods or long-term investment like housing is in this kind of downturn, the price expectation for residential homes has already been quite weak. With this oversupply in the market, it's just really hard for me to see there's any way to turn that around. But maybe in 2 years, I can totally see around the end of 2025, when we have another decline for 2 years for the new investment in the residential home market, then the pent-up demand in the housing market could exceed the supply of housing at that time. Then I can see that consumption can ultimately be pulled up again by the housing market. But this year, one problem for me to believe that is the housing prices are still going down. And although the local governments are trying so hard to stabilize or to put a price floor to how much the new home price can go down, there's essentially very little transactions for third-tier and fourth-tier cities. Most of the transactions happen in the existing housing stock and in big cities. So that has become this ongoing phenomenon that people are so afraid that real estate developers might go bust anytime soon. So they tend not to get into this prepaid scheme or buy any of those housing that's not built yet, started construction yet. And simultaneously, when we look at the sales of the existing housing stock, they actually perform relatively well. In the past 3 years, they actually increased by 9% in terms of sales. So that's one reason I don't think consumption can really go up this year. Another big constraint is that income and labor market. So for the income prospects, this year, I think the income growth is probably going to be slower with the ongoing restructuring in many of the industries. For the manufacturing sector, it has gone through this automation phase. And companies are trying to cut their costs quite ruthlessly for a few years now. And this year is particularly difficult because many companies have the liquidity problem. It doesn't matter if you're SOEs or POEs, a lot of them depend on the government projects. So if the infrastructure spending cannot be expanded significantly and quickly, then a lot of the domestic companies will run into big problems. Even if that happens, it still means only the best and the biggest in the industry along that supply chain could benefit, and it still doesn't generate enough jobs. We will get another maybe 12 million of fresh graduates this year, and that's a huge pressure on the labor market as well. So for consumption to be the driver this year, I think it will be very hard for me to make that conclusion.
Thank you very much, Wang. I think both of you agree that so much depends on the property sector. Clearly, where the property is heading to is a question mark. Improvement in property sector or stabilizing the sector would boost or spur confidence, consumption, and also investment. So let's see, whether something can happen in the rest of the year in this particular sector. Clearly, we have three traditional forces behind growth: consumption, investment, and net exports. How to basically, look at the situation where growth could come from these three areas is a key question facing all of you, all of us. So this is very helpful. Steve, please.
Sure. So I have the advantage of the last mover on this question, so I can really build on the great comments of the previous two. And you're going to hear a lot of the same themes. Let me say, our last forecast for China was published in January, and we were at 4.6% growth. We won't publish another forecast until next month. That's for this year's growth. You could say maybe 4.6 is around 5. It does round up to 5.0, so let's see. But I'm going to hit on the policy theme, and I think it's right to start with real estate, because I think you'll see all of us are focusing on that, and I think for the same reason. It's really important for understanding developments in China. I think our assumptions are real estate's maybe somewhat between Tao and Dan. You know, if we compare the peak for starts and sales in 2019, we've seen that both are roughly down 50%, plus or minus 10%. So last year, starts and sales, I think starts were down, around a little more than 50%, and sales not quite. Much of the adjustment we think has taken place in these variables. We have still a modest decline this year in starts and sales in our forecast, and then a pickup or normalization. But as Dan was saying, there's still inventories to work through. So for us, gross fixed capital formation or investment in real estate will still kind of decline a little bit the next few years before starting to pick up around 2027, 2028. But maybe our real estate's kind of in between the two. That's our forecast. But I'm going to turn a bit to monetary policy, an issue that maybe we haven't touched on, that we see room for monetary policy to be accommodative. And at the fund, we've been arguing for the benefits of relying more on interest rates as a way to achieve the accommodative monetary policy. On composition of growth, I think maybe a tiny difference in our numbers. And again, this is based on our January numbers, but we actually have net exports being a small drag on growth this year in our current forecasts. And that comes to what could be the drivers of growth. And here I'm going to pick up on the themes that the other two speakers mentioned. I think it's really important to look at ways to boost consumption. And here I think it's important to think not just about a cyclical support, but how do we have a lasting support to consumption? And I think here there's measures, fiscal policy can really play a role here. We can look at changes to the tax code. For example, we know that income taxes on low-income people are not that high in China, but if we count payroll taxes, pension taxes, that the tax wedge in China is actually fairly high. So there's space to reform that, to put more disposable income in the hands of lower income households who have a higher propensity to consume. So this is an example of the kind of policies to boost consumption. Strengthen the social protection system so households have less of an incentive to do precautionary savings. These boost consumption not just in the short run, but actually in the long run. And it would be great to see a long period where consumption in China continually grows faster than GDP. That would, in some ways, be a proxy for living standards growing faster than GDP. I'll stop there.
Thank you very much, Steve. I think 2 points on the real estate sector. We always compare China now with, we say, in the past, right? Past sales basically jumped so much every year. Prices rose so quickly. Now, my question is, there has to be there must be a lot of studies, right? International comparisons, whether the sort of similar situation experienced elsewhere. What lessons, can China learn from other crises, similar crises, to deal with the current issue? Now, maybe at some point that we should come back, to discuss this issue specifically, to see the international comparisons, because that's the relative or comparative advantage of the IMF, given IMF has information data for all economies. So maybe that may be helpful. Second point is, your message is both monetary and fiscal policies still have a room to play some role, right, in helping boosting consumption. So therefore, I think that these are also the messages in the staff report last month released. So very helpful. Now let me switch to a different question. Now the concept of new productive forces has drawn a wide interest and a lot of discussions. So I have 2 questions for you three to think through or respond. What is your understanding of this concept? Secondly, to what extent can emerging industries such as electric vehicles and other high-tech and green sector developments replace the traditional drivers of growth this year and beyond? So these are 2 questions concerning this concept. So could Wang Dan please start, then Steve, and then Wang Tao, if you don't mind. 3 minutes, please. Thank you.
The high quality productive forces to me, it's about the long-term growth, and it's a technology and innovation. I don't see a change in nature from the previous year's policy that has been focusing on spurring innovation. And that also means we know exactly where the capital is going from the investor's perspective. In this year's 2 session, the Premier has listed several industries, including the new energy, new material, marine technology, biotech, things like that. So they will get more support, both from the public sector, majorly from public sector, and a lot will be from private sector. And that will become the foundation for China's industrial landscape 10 years down the road. So I think that's also one reason that we're not focusing so much on the short-term demand, the Keynesian style of the macroeconomic stimulus. In the past 20 years, before COVID started, it's basically the main theme of Chinese policies. But then slowly, around 2016, 2017, we started to see this major shift towards the green transition. It looks like, and I agree, that decarbonization is this once-in-a-lifetime opportunity for China to really become powerful and strong, just using their phrase, by 2035. And that also means the short-term economic woes would mostly be borne by the consumers, by individuals. The income reallocation and the resource reallocation will be more skewed towards manufacturing and heavy industry instead of those soft tech in consumer sector. And I think that will have some profound implications for the talent structure in China, and also for what people can expect in terms of the job market choices, and also for the future of some of the long-term problems, like overcapacity, for example. Before 2020, the highest number of Chinese major was still teaching, like Shifanshen. So then the number 2 is management. So those majors were very popular back then, but then now we can see there's a real shortage for students in major like software engineering or aeronautics, astronautics, those hard tech. And there will be a faster transition in the future for what people will choose to study in school. And then slowly we'll bridge that gap in the supply and demand in the labor market. And on top of that, there will also be more of a stress on how can we find a new market to absorb all those overcapacity. Because I kept thinking about, since we have our eyes also on the new energy sector, that's what every bank is fighting for. They represent the future. They have the best cash flow. It doesn't matter if they make profit in the short term, as long as they have healthy cash flow and a high forecast in the future, then we're getting into there. But then how can we find enough market? The domestic is still the bulk, but overseas market, especially the European market, will be the key for the success. So in the short term, it's not just the economic agenda, it's also the diplomacy, it's also how China is going to play out in the China-US competition scene. So, and that means companies, domestic Chinese companies, have to change their strategy really away from just being a national company, slowly to maybe multinational company or even international company that is trying to explore overseas market, broaden the view, basically. Thank you.
Thank you. Thank you very much, Wang Dan. Steve, please. Either Steve or
Sure.
it's Wang Tao. Yeah, Steve. Yes. Yes.
Okay, I can go. Yeah, I think, let me take a slightly different approach to this question. You know, one way to look at growth is to look at sectors, and we've all been talking about real estate. But let me give you another way to look at the drivers of growth. And kind of a classical macroeconomist, which I'm guilty of being, would tend to look at a production function approach. So what drives growth is growth in the workforce, labor, adding machinery, so capital, or using it better, total factor productivity. And ultimately, what drives growth in the long run in economies is this use it better. You know, the ability to use capital and labor better. And, you know, if we look at China's remarkable success in the last several decades, we can really map that back to big gains in total factor productivity, using it better. The flow of labor from farming to factories in the 2000s drove really rapid growth. We had a decade of growth above 10% in China. And this is really from total factor productivity. So I think the key, going forward is how to boost total factor productivity. And here I will map to some things in the work report. I have had the pleasure of working on China for the IMF off and on for actually more than 20 years. I think I'm called senior res rep because I'm old. And I'm an avid reader of the government work report. It's really one of the, if I could pick a document to read each year from the government, that's probably the high on my list. And, when you think about, I'll give you the kind of following phrases about how to get total factor productivity growth in the economy. And let the audience guess if it's from an IMF report, from the government work report, or both. And actually, what I will say, in the government work report actually mentioned raising total factor productivity. It's not very often as an economist you see that in a high-level report that explicitly mentions raising total factor productivity. And how do we do that? One way is ensure the market plays a decisive role in the allocation of resources. So basically, pro-market reform. A second way is to get a world-class business environment that's market-oriented, law-based, and internationalized. Another way is to ensure a level playing field so that all firms, privately owned, foreign owned, state owned, compete on a level playing field. And the last is to unify the domestic market, get rid of local protection, market segmentation. And these are the ways, these kind of pro-market reforms to generate this total factor productivity growth that ultimately will drive growth in the long run, especially in China, given that capital stock is high and the labor force, the working age population is shrinking. So really puts the burden on this use it better. And again, I'll let the viewers guess which of those words are from IMF report and which from the government work report.
Thank you. Thank you, Steve. Thank you very much. To our audience, Steve has been very modest. Senior resident representative, what senior means knowledge, policy experience, and also leadership, not age. Anyway, so you summarize the importance of pro-market reforms. These 3 or 4 areas, right, remain the key for the economy in the long term. So we'll come back on the longer term issues a little bit later on. Thank you. Wang, please.
Thank you. So President Xi actually explained very clearly what he considers are the definition of new productive forces. So I encourage audience read what he has said, and indeed, the focus is increasing productivity. And what Stephen mentioned, the total factor productivity, about using resources better, is a key part of it. And how do we get there? There's certainly innovation is a big part. Innovation is key. But innovation, as President Xi pointed out, does not just mean working on some high-tech sectors. It can also mean upgrading the traditional sectors and making those sectors work better, and also using the labor and capital better. So reforms as well. So I think maybe some local government officials may have a misunderstanding to say we all need to get into EV or renewable energy or semiconductors. And President Xi, I think when he visited the Jiangsu province delegation, he specifically, emphasized some during the two sessions, emphasized that, doing better in your traditional sector is also increasing productivity and new product force. And so that's my understanding. So innovation so the EV and so on happens to be sectors that China has been very innovative, and so those are examples. But I think China can equally improve productivities in the steel sector and in this so-called sunset industries. China is in the traditional automobile industries, in equipment and machinery. China has gained a lot in that space, in global market share and in its productive capabilities as well. So I think those things, using automation, digitization, to continue to move up the value chain. So those are going to be the new drivers of China's growth. But indeed, I think focusing only on the supply side has the risk that China could once again have excess capacity in many of these new areas. And that would be resulting in a wasteful allocation of capital and labor, as China has done in the past in some of the sectors. So therefore, I think, for sustained growth, you also need to look at the services and the domestic demand. So can't just focus on, I think, the supply side. And so for government to pick winners probably is not a good idea. And the market, I think, will work out what are the new areas, what are the new products people really want, and what are the new things people really have demand for.
Thank you very much, Wang Tao. In your book, Making Sense of China's Economy, I think you laid out very clearly, convincingly, what's behind the growth of the TFP. So I encourage our audience probably to buy the book and read it through. I read it a few times. I read it a few times. I learned a lot. Anyway, together with an IMF report and also Wang Dan's many articles. I just have one question here, but we don't have time to go through the question, maybe for another session in the future. While manufacturing innovation is important, however, whether and how to encourage investment in services and how to encourage service sector growth probably is also important, given that the share of GDP services in China only about 55%. Elsewhere, advanced economies, right, 80% or 75%. Even in other emerging markets, 75%. So therefore, probably if we have opportunity, we can discuss that issue in the future. Now, let me ask one more question quickly, then we have several other questions from the audience, so we have to go through. My final question is about China's external sector developments. Again, this topic was mentioned earlier on. Traditionally, exports have been an important source of growth for China. Over the last few years, however, China's export growth slowed down significantly, though we've seen a good recovery in January and February this year. At the same time, FDI inflows turned negative last year. What are the contributing factors to these developments? Are they a concern? In light of the strong data, in the first 2 months this year, are China's exports turning the corner for a better year in 2024? Relatedly, partly as a result of geo-economic fragmentation, the ASEAN region has now replaced the US as China's main trading partner. In this context, how do you see the outlook for China's exports and FDI inflows in 2024? And what does it mean for Asia and the rest of the world? Actually, this question, part of this question has been also asked by Caijing magazine to Wang Tao. Given that, Wang Tao, if you don't mind, I'll approach you first. Then I will ask Steve and Wang Dan to comment. Thank you.
Thank you. These are very complicated questions. On the FDI, I start with FDI. FDI for the overall of 2023, in the end, it turned positive. It was not negative. The fourth quarter improved. But nevertheless, it shrunk substantially compared to before, to a fraction of what the average of the previous 10 years has been. So there are a number of forces behind it. One, I think, is so some of the forces are more short-term. For example, the FDI data that the balance of payment account published by SAFE includes retained earnings, includes also lending by affiliated parties, and PE and so on. Those things in 2023 declined very sharply. That would be my estimate. There's no detailed number on it because companies didn't do that well. In end of 2022 and 23, so earnings were down. And then also the dollar interest rate had increased very sharply. So in international funding cost is very high compared to funding cost in China. Even when people are very optimistic about China, they would not borrow dollar funding and invest in China. That would be very uncommercial for them. And PE, of course, also had, in the tech sector has faced some regulatory tightening earlier and so on. So there are a number of those reasons. And also, I think foreigners were not able to come to China for a few years during the pandemic. So there are those issues. I think those issues are going to fade. So we expect a recovery of FDI in 2024, mainly on, for example, earnings. Of course, retained earnings coming down could also be companies repatriating them abroad because they lost confidence in China. But looking at the BOP data from last year, that seems to be not the case. Repatriation was down significantly compared to 2022. So it's mainly because they did not make a lot of money. However, I think there are long-term issues for FDI, which include that economic fragmentation, decoupling pressure, supply chain shifts for whatever reason that investors are, for long-term concerns, are not really coming in as much as before. I think that's a more of a structural reason. I think there's also belief that China's market may no longer grow as much as before. So those are some of the longer-term issues that may be harder to resolve. There's also perception when people haven't come to China, there's perception that the business environment has worsened. But if you talk to businesses who have worked in China and stays in China, of course, they give you a different picture. And China, the government has started to open more sectors. So I think some structural issues, the government can help improve the business environment, improve the perception and so on with more opening. Some of the structural headwinds are harder to really overcome because of geopolitical and global economic shifts. So I think in that sense, I think FDI will rebound, but we don't expect it to really go up as even to the previous 10-year average. We think maybe even to half of that would be already quite good. So it will have that decline of FDI will have an impact on China's exports over the long term, potentially, especially if the supply chain continue to shift. In the short term, for 2024, I'm very confident that exports will do better than last year. So from that sense, exports have turned the corner again. The global tech cycle is a big factor. And also global import demand, we think will do better this year than last year. So that's the overall external environment. Also, I think China remains the largest manufacturing powerhouse and has unrivaled, supply chain, complex supply chain and so on. And Chinese companies are very adaptable. When something is being restricted, they export something else, intermediate products, and they export to Southeast Asia, Mexico, and so on and so forth. So in the short term, in the next coming year, I think they will actually do better with the global environment. Over the long term, as I mentioned, I think there could be headwinds, and export over the long term may face some pressure.
Thank you very much, Wang Tao. Since you're here, can I ask a question for Caijing magazine? The question is, in the first 2 months of this year, the foreign capital investment in bonds and equities in China have increased, while FDI is still weak. So their question is, does this movement two up, one down reflect, the basic economic situation in China and also the foreign investors' sentiment or views on the Chinese economy? Could you just simply elaborate this way? We'll answer citing magazine.
Sure.
Thank you.
So on the capital market inflows, I think there are two kinds of, so for FDI, I think investors tend to consider more of the long term. And for capital markets, both long term and short term come into play, and especially short term. So we do notice net inflows into the bond market and equity market. But on the bond market, I think there are two things. One is that people expect China's bond yields to go up, interest rate to go down, because they, when you are long on the bond market, you are actually not optimistic on the economy. So that's one reason. Another reason, of course, that there is potentially structural rebalancing. So sovereign wealth funds and pension fund and so on, structurally increasing their allocation into China. That's a long-term thing that we have noticed that's been happening. So on the bond market, so it's both a bit, there's some long-term confidence and also short-term transactional considerations for going into China. On the equity market, it's harder to say. The overall position of external global investors in China's Asia market is very low. However, when people consider that market valuation is very cheap and that the government is going to boost the economy and the market, there will be some inflows. And from our experience, those inflows so far has tend to be the hedge fund and so on, not so much a lot of long-term investors. So it's really about what they expect will happen to market in the next few months, rather than the overall economy.
Thank you very much. Very helpful, Wang Tao. Steve, please.
Sure.
Thank you.
I was going to try to tackle both the FDI and the trade, but since I think Tao just gave one of the best explanations I've heard on FDI, I will skip it because it's really complicated. And she just, I think, a very clear explanation of the FDI. So thanks, Tao. Let me focus some comments on trade and exports then. I think when, one thing, when we look at China's exports and the month to month and whatever, I think it's sometimes useful to step back and remember that during the pandemic, especially early on in 2020, 2021, exports in China were very strong. And some of that was the sort of mirror image of the pattern of demand we saw in the US, where goods imports in the US, goods consumption was very strong, services consumption was weak. And some of what we've seen is so-called export weakness of late. I think some of that's just a normalization of exports back to the, let's say, pre-pandemic trends. So as the pattern of demand in the advanced economy switched, more back towards services and away from work from home goods, medical goods. So I think that's one point on exports. I think the second, over the years, exports as a share of GDP, if you want to use that as a proxy for the importance of exports to China, have fallen a lot. I mean, I can remember days when exports were around 30% of GDP. Now they're typically below 20% of China's GDP. So, exports are clearly, they're still important for the economy, but less important. I think the third point, at the fund, we look a lot at the current account balance. And here, again, I can remember days in the run-up to the global financial crisis where China was having current account surpluses, in the order of 10% of GDP. And our estimate was last year was about 1.5% of GDP, the current account surplus. And we have that gradually declining to below 1% of GDP over the medium term. And, we have a framework for assessing the external position of economies. It's called the External Sector Report. It comes out once a year. It's a big effort to give a multilateral, consistent assessment of external positions, And since 2018, we've assessed that China's external position has been broadly in line with fundamentals and desirable policies. So that's sort of on where we see China's trade and exports. I mean, just maybe one last observation when we're on this broader topic of trade, maybe looking beyond China. I think it's really important to remember that trade has been such an important engine of global growth over the past several decades, and that it would really be great to get back to a world where instead of talking about fragmentation, we're talking about making trade a global engine of growth again. Instead of talking about putting restrictions in place, we're talking about how can we strengthen the multilateral trading system with agreements in new areas like digital economy, services, investment. You know, it'd be great to get back to that, but maybe I'm hopeful.
Thank you very much, Steve. I think I agree. Both the IMF and World Trade Organization projected that this year, 2024, trade volume may grow by 3.3%, in line with the real GDP growth, world GDP growth rate. Vis-a-vis, last year, basically no increase or negative. So hopefully, export prospects will be better in 2024, as Wang Tao put it. Back to you, Wang Dan, please.
So I'll only add a small point to the FDI, because I kept thinking about this decline trend. China has seen it several times in its past 20 years, so it's not something new. But China is a lot richer than 20 years ago. And one question that's quite critical to me is that why do we think still that some resources and assets are more productive under the foreign hands rather than in the hands of domestic companies? Because that's essentially what FDI is. It's the ownership of those resources, whether it's managed by foreigners or managed by domestic producers. And when I meet clients, they usually would worry about supply chain decoupling or sanctions from Europe or US. But then if you really push them, what's really bothering you in your business in China, they will always end up with one thing, and that is local competition. So for Chinese domestic companies, they have gone a long way. And now for a lot of the industries, they are competitive enough that there's no point actually to have the FDI in China. The government doesn't really play a role in this. It's, of course, the state-backed model and the industrial policy has played a role. But automatically, we have came to this point that FDI is no longer essential for driving China's economy. And for its relationship with export, I would like to offer one observation, because there's not enough data on this. But the decoupling in the high-tech sector doesn't really do much harm to China's supply chain. But the requirement for the country of origin has really done some harm to certain regional economy in China. For example, if Dell has moved its production line away from Nanjing, for example, then their suppliers will have to follow it. And then some of the final production of those goods are done in either in India or in Vietnam or Cambodia, for example. But when China had the whole supply chain in within the border of the country, then this whole thing in the middle of the production, it doesn't count as export. But now you put the last step outside, then you export intermediate goods, intermediate industrial inputs. And when you do that and export those to a foreign factory, those factories tend to overstock. So I don't have the full macro data, but if you check from industry to industry, sector to sector, factory to factory, the available data will show that those factories tend to overstock. So China has a real advantage of producing the intermediate industrial inputs at a large scale. And because we export those things now a lot more than before, due to the reasons including the over inventory of overseas production, then that actually is a driving force for China's export. So yeah, that is my observation for this.
Thank you very much. I think this is perfect because we have two related questions from our audience about the export and then overcapacity. So the question from Kate Brasher, New York Times. Kate, thank you so much. Welcome to this discussion. So his question is, net lending to industry in China rose from $83 billion in 2019 to $670 billion last year. should other countries be concerned that this may contribute to industrial overcapacity and lead to a surge in China's exports? Relatedly, a question from Seng: how severe is the overcapacity issue this year? Seng said both Wang and Wang Tao mentioned it. And what are the short-term remedies and the long-term fix for a possible overcapacity? So I'm not going to ask all of you, three of you, to comment on these questions, but whoever would like to answer, please, feel free to do so. Overcapacity, export should be concerned. Thank you.
Maybe
Wang
I'll
Tao, please.
start. Yes, I think I am familiar with that question Keith asked. I think looking at net lending to the manufacturing sector is only partial picture, because their overall funding for investment tend to come from also commercial bills and bond issuance, as well as their own funding. So when other fundings are weak, then they tend to borrow more, so bank lending increases to those sectors. And the other two sectors that typically absorb a lot of credit, property developers and local governments, face serious constraint of access to credit at the moment. And so therefore, manufacturing banks would love to lend to manufacturing, and there's definitely government support. But the overall manufacturing investment, CapEx spending, last year grew by about 8-9%. It was not growing in 30+% as the net lending shows. So I think that's probably a more overall picture. But the basic question, the fundamental question, of course, that Keith and Seng mentioned is access capacity issue. Is there a concern? Yes, there is concern, even in some of the new industrial sectors. And I think in China, we are in almost like a perfect competition kind of textbook world. When something makes money, everybody wants to invest in those sectors, and that's driving the margins down. It's good for consumers, not good for profit, and we will have excess capacity in some of the sectors. How to resolve that? I think boosting domestic consumption would help. And also, I think again, for the authorities, maybe, just give guidance and not necessarily, channel all the funding into certain sectors, because that does lead to overcapacity. So this year, I think a key concern for me, I think, again, I'm like sounding like a broken record, but if property market does not stabilize, we're going to see bigger excess capacity in many of the industrial goods areas, including construction materials, machineries, and steel, and so on and so forth. So I think stabilizing domestic economy, stabilizing demand will be important. And then on the supply side, I think having some market discipline, so that we don't have all local governments all jump to similar industries, will help limit that excess capacity.
Thank you very much. Any further inputs to this question? If yes, then we'll, otherwise we can move on to other questions. One time, please. One time, then Steve.
Overcapacity. So I think the best way so that we have overcapacity in both traditional industries and the emerging industries, and that means new energy sector, new material. We have overcapacity in that, as well as cement, steel, and glass. So to resolve the overcapacity in old industries, I think the best way is really to let company go under. So there should be more bankruptcies and consolidations in those traditional industries. There are no good ways around. But then for those emerging industry, I think there should be more of like a 10-year plan rather than of a 3-year or 1-year plan, because the global demand for green products, for example, when it's related with decarbonization or green transition, it's still in shortage. So there is room for China's production, but in the short term, maybe disrupted by different forces, then there's no way to digest them. But it doesn't mean that China should let those good companies go bust. So there should be some smooth measures for those companies in order to help them. And on top of that, we need to explore new markets to absorb those capacity.
Thank you very much, Wang Dan. Steve, please.
Sure, maybe just a quick comment. And our Article 4 report on China that we just published, and then as well as Article 4 reports, our annual reports for the US and Euro area, we did focus on industrial policies and trade distortion. So, on China, the main takeaway on industrial policy and trade distortions was that to roll back the recent and longstanding policies that have generated negative spillovers and contributed to fragmentation pressures. That's sort of the one line sentence on our takeaway on that issue. And I think to build on something that Dawn just said, her last comment, we sometimes call this market dynamism, the exit, and having a dynamic market where unproductive firms exit actually is one key way to boost productivity. Low productivity firms exit, they free up resources to go to more productive firms, and ensuring a very dynamic market like this is also an important way to support the local economy.
Thank you very much, Steve. So let's move on. A question from Dari from Singapore, 联合早报. Great information session here on China's economic prospects. A follow-up question on the property slump. There have been quite a few property support measures that have been put in place over last year to stimulate the sector. Why do you think these measures have not yet achieved sustained recovery in the property sector? What else, specific measures would you suggest on better stabilizing the property sector? So why policies have not yet, seen the results? Anything else need to be done? So anyone would like? Oh, Steve, please. Steve.
So I can, real quickly, just kind of summarizing, perhaps too quickly, the main takeaways from our report in this area, because it was a big focus, was, one, accelerate the exit of unviable property developers and the restructuring of viable ones. Fix the pre-sales model. We know an issue in housing is the pre-sales. There's both a stock and flow aspect to the pre-sales model. The third would be to ensure that prices can play the role in clearing the market. And I think our last bit of advice on properties, there's a role for public housing. It can both generate demand and address some of the affordability concerns. So, in a nutshell, perhaps too high level, that was the 4 key areas that we focused our advice on with regards to the property sector.
Thank you. Any additional Wang Tao or Wang Dan?
So maybe a little bit from me. I think a key reason for the continued downturn in the property sector is that a big part of that is structural, in that the fundamental demand and supply have changed. We have shrinking population, slowing urbanization. At the same time, 2-3 decades of massive buildup meant the home ownership is high, and most people live in properties that's built in the modern era. So the natural demand is lower. So I don't think one should have any expectation to go back to, to reflate the property bubble and go back to the previous peaks. And I think the government is rightly to want to move on from that. In terms of policies help to stabilize market, there have been a lot of announcements, but the most notable measures has been to provide some credit support to developers and also lower down payment requirement and mortgage interest rate for home buyers, and also easing some purchase restrictions. So what's more can be done? I think in all these areas, more can be done, and especially provide credit support. I agree with the, letting some unviable firms to exit. However, how to do that is very important. I think restructuring coordinated by the government is very important. If you just let the market force the deleveraging, you can have overshooting. I think in that, China should actually learn from experiences of Korea and so on to do out-of-court settlement and debt restructuring for the developers. That can also help boost confidence of buyers. because buyers are worried that new homes they buy will not be delivered and on time, so that hurts the confidence. And also hukou reform in relatively large cities of 3 million to basically tier 2 cities, more than 3 million people, can also boost demand. There's still certain parts of the Chinese urban areas still have, I think, net demand.
Thank you very much. Wang Dan, any further inputs? Yeah, thank you.
Add a point on the real estate developers. I think the government has to put some fiscal money into a fund that can help the real estate developers. Because so far, this is on the supply side of the housing market. The measures are mostly to ask banks to extend loans to those developers. It's not going to work. And when potential buyers see that all those developers can have potential problems in the future, they're not going to buy those homes with prepaid scheme. So that's reflecting the data too, because people are still buying the existing stock instead of the prepaid scheme stock under construction or going to be constructed. And one other small thing is I can see that the goal for the housing policy is to stabilize the housing price, and that can drag this housing downturn for a lot longer. It may not be necessarily a bad thing, but it also means that people will not get back into this market as soon as quickly as we want them to.
Thank you. We only have 4 minutes remaining. Can I ask 2 more questions? You can put them together. One question from Wall Street Journal from Jonathan Chen. Jonathan, welcome. So the question is, what are your predictions of housing prices? Very tough. New home and secondary homes. Where do you see the biggest jobs would be? How about housing prices in the first tier cities? So all concerning the property sector. So that's a question from Wall Street Journal. Now let me also quickly mention, there are 3 questions from China Daily. One is about the recent economic performance, which I think our panel has already touched upon quite comprehensively. The second question is about the new quality productive forces. I think we also have discussed this. Now, that is a question, I don't know whether you can comment, say, this with China planning to issue ultra long-term special purpose bonds over several years. So which pivotal sectors do you believe these investments should target to drive the advancement of new quality productive forces? So where the money should go? Now, China Daily has another good question on the medium-term prospects, issues, right? Basically, how to continue grow over the medium term, say through 2035. So the medium term question actually was on my agenda, but we didn't have time to go through. So 3 questions or 2 questions, please, wherever who would like to say anything. Thank you. Steve, please.
I can take the one on medium-term growth. So, we have a medium-term growth forecast. And as you know, at the IMF, medium-term is 5 years. We have medium-term growth at 3.5%. But, we think it can be faster. And I think the government, as you'll see in our report, also argues that our forecast is too low. And ultimately, medium-term growth will depend on the pace of reforms, to be very simple. So better and stronger structural reforms could be higher medium-term growth. We have a scenario with stronger implementation of reforms, and we get medium-term growth at roughly 4.5, so about 1 percentage point higher. So that's my comment on that.
Thank you, Steve. Thank you.
I can comment on the long-term construction bonds. I think just to repeat earlier, I think the government should not pick winners and losers and by directly invest in industries. But the government can do, as the Chinese government has done very well in the past, is to build better infrastructure and foster that transition to new growth areas. So in this particular case, I think facilitate the green transition building, for example, upgrading the grid system, building smart grid, and also spending on energy conservation and environmental projects. Those are the things that will be very important, I think, for the long-term transition. And also, I think, spending on building public services as well in rural areas, in lower tier cities, that helps to boost, the middle class and overall consumption as well.
Thank you very much, Wang Tao. Wang Tao, please.
I'll add a bit on the ultra long term, the government bond. I find it an effective way to lower some of the burden on local government, but also it flooded the market with bonds. And when government issue bonds, essentially are taking liquidity away from the economy and pull it together. And then that investment will be on projects that's in a closed circle. And this circle, the projects can mostly only be taken by the large POEs or SOEs, doesn't generate a lot of the jobs. So fiscal multiplier will be lower. I find it's not a sustainable solution to China's growth problem. And on top of that, because bond market is the only well-performed market in Chinese financial market, the stock is not good, housing is gone, but we have 140 trillion RMB of deposits, household deposits in the bank. Those money has to go somewhere. It cannot be dumped in bonds or stocks. One way or another, it has to find its way back to the housing market. And at some point, it has to become the pillar industry again. So yeah, I digress. But my point is, the current situation of prioritizing the bond market or relying on bond market is not a long-term solution.
Thank you very much. To Wall Street Journal, the question about the housing prices, housing sector, I think our discussion already have covered the points quite comprehensively. Anyway, so now is 9:32. We are 2 minutes about our time limit. But thank you so much to our three panel speakers. You are just great. You covered so many questions. Clearly, if we have a longer time, availability, we can continue. But let's have another session another day. So your discussion, your points of view are very informative, very insightful, and also very honest, very candid. The discussion is so rich that it's unfair for me to summarize any points. It's not possible also. But anyway, so thank you so much to three of you. Let us also thank our audience, for joining us today. Interestingly, I just learned from the Zoom, you see, we only have 59 participants. Actually, we have probably 1,000 or 2,000 people watching from WeChat. So I've been informed by IFF. So a lot of people online from different areas, schools included, universities included. But anyway, so I'm going to stop here. Thank you all so much. So let's keep in touch. Stay well. Thank you.
Okay.
Thank you.
Thank you.
Thank you.
Thank you. Thank you.
Thank you.
Thank you. I hope to see you three, sometime soon.
Me too.
Okay.
That'd be great.
Bye-bye.
Right.
Bye-bye. Bye.
Bye-bye.
Bye.
Bye. Bye.
Bye.
Bye.
Bye-bye.
Bye-bye. Bye. Bye.